All right, good morning, everybody, and thank you for joining us for our webinar hosted by CEDM, MISHDA, and the MEDC. My name is Emily Rice, and I am the Communications and Training Associate at CEDM. If you're not familiar with CEDM, we are the statewide trade association for community economic development in Michigan. So we provide advocacy, training, and resources, much like this webinar, for example, to organizations working to create vibrant communities in the state. So if after this webinar you're interested in learning more about what we do or you're interested in membership, please feel free to contact me. My contact information is on here. And if you are already a CEDM member, please let me know if there's anything else like this training and webinar that you would like to see in the future. I do want to highlight just a few things that MISHDA and CEDM are working on together. The first is the Low-Income Housing Tax Credits Workshop that's coming up in August. So I felt like this audience might be interested in that event. That's going to be August 7th at Lansing Community College's West Campus. So put that on your calendar. You can find more information about that on our website. And also in August is our Developing Vibrant Communities Conference. That is going to be August 21st and 22nd in Detroit. So you want to put that on your calendar as well. We are opening registration for that this week, so definitely look out for that. So before I hand it over to our host, I just have one housekeeping item. You are able to ask questions at the instant message box on the lower left hand of your screen. Feel free to utilize that. We'll be monitoring that as we go along. Some questions might be hit on later in the presentation, so we might not answer them right away, but just know that we are looking at those and we will get to them. If you have any questions, you have any issues during the webinar, feel free to shoot me an email. My email is right here, or just instant message me. You can choose who you send that message to, so if you just choose presenter or co-chair, chairperson I think it is, you can go ahead and do that. So now let's introduce our speakers. Today we have Bryan Mills, he's the Chief of Staff at MISHDA, Greg Tedder, the Executive VP at MEDC, and Kristen DeKuyper, she's partner at Holland and Knight Law. So I want to thank all of you for coming together and putting this webinar together. We really appreciate it, and I will hand it off to you guys.
Great, thank you, Emily. This is Bryan Mills, one of the few people that are speaking today, and we will try to keep our comments brief, yet to the point, because I believe the intended purpose of today's webinar is to make sure that we gather and collect as many questions that all of you have, so that we can provide as much direction, insight, and knowledge that we have gathered thus far for all of you. So with that being said, let me touch on a couple of reasons why we're having this webinar. I believe I see a lot of familiar, how can I say it, names, not faces, but I see a lot of familiar names on the participation list. Many of you I've spoken with personally, and we thank you for joining today and being part of this webinar. I wanted to explain exactly why we're here and what we hope to accomplish, and then hand it off to those that are far more astute with regard to their knowledge and expertise on the subject matter of the day. So why we are here. I wanted to just explain exactly that we hope to put you in touch with a couple of key people as we move forward, and so that you can have some points of contact. For example, we will have Greg Tedder speaking. Should I stop talking and ask for some comments as it relates to whether or not they hear us?
I think they cannot hear us.
Okay. If people can hear me, could you provide some feedback and say, yes, you hear us? Sounds like many people are hearing us now.
Okay.
Perfect.
So if you can't hear us, maybe try calling in again. It might be your audio, and make sure that you are on the phone as well.
Perfect. Excellent. Let's get right back into it then. Providing some points of contact for all of you as we move forward with uncharted territory. First and foremost, I'm going to introduce you to Greg Tedder. Greg is the Executive Vice President and Chief Community Development and Marketing Officer over at the MEDC. His role and responsibilities for today will be twofold. First and foremost, to talk about how we can enhance collaboration through different mechanisms that he's involved in, like the Regional Prosperity Initiative, regions around the state, and some ideas that he has around that. And also, he will be here to provide points of contact for all of you as you move forward with multiple questions, issues, data, information, etc., as we move forward collaboratively together. Secondly, we will then hear from Kristen B. Kuiper, who is a partner with Holland and Knight and based in Boston. When I talked about people that are far more knowledgeable on the subject matter, that's what we're talking about. So I expect many questions today will be directed at Kristen. She will be giving more of a, how can I say it, a private investor perspective, specifically talking about what is a qualified opportunity zone property, who can create an opportunity fund, how will opportunity funds be invested, et cetera. All of the very questions since we have adopted opportunity zones in Michigan that have now been surfacing and coming to us. So with that being said, let me turn this over to Greg Tedder to cover a couple of items before we then turn it over to Kristen. Greg?
Thanks, Brian. This is Greg Tedder, MEDC. I'm also going to be brief so we can get over to Kristen for the meat of the presentation. So just a little bit of background. I'm going to talk a little about MEDC's role and sort of how we're organized. So the state's divided into 10 RPI regions, standing for Regional Prosperity Initiative. So at the MEDC, we have field staff assigned to each region. The field staff for the MEDC, they live and work in the regions, so they're field-based. And you can find those points of contacts right on our website. miplace.org. If you're a developer, if you're a community, resources are right there for you to find the appropriate point of contact for you in your region. So generally speaking, the MEDC, we have both business and community development programs. From a business development perspective, there are programs, and I'd say in some cases incentives, available for job creation directly with the company if there's out-of-state competition for high-paying jobs in certain targeted industries. For community development, there are programs, and again, in some cases, incentives for mixed-use projects in downtowns or high-impact corridors or gateways. And we've got certain criteria that we evaluate projects on, primarily local and regional impact, certain placemaking and design characteristics, and most importantly, economic and financial considerations for state resources and state support. There are also other state agencies that have programs and in some cases possibly funding that's available that can be leveraged in certain instances. MISHTA, for example, here today is affordable and sort of workforce housing program, but the Department of Agriculture, Department of Natural Resources, Department of Environmental Quality, they all sort of have relevant programs also for the subject matter that we're going to talk about today. So I think my main message is basically that if you're contacted by an opportunity fund, you should contact your RPI CAT team member, RPI Regional Prosperity Initiative, depending on where you are, CAT team, Community Assistance Team. You should reach out to them sort of directly and then have an initial discussion on the proposal. And if a project meets the goals and objectives at the MEDC, which I very high level outline, but there's much more information available on our website, there could be an opportunity for us to leverage funding. If a project doesn't really meet MEDC like guidelines or programs, but could be assisted by another state department, then the MEDC field staff would refer you to that appropriate person, whether it's at the DEQ or agriculture or natural resources or whatever it might be. If you're an opportunity fund, we're kind of working together here at the state level to develop a central point of contact on opportunity funds that are interested in working with state departments. And a lot of that is really going to depend on the opportunity funds, investment goals, and criteria as they get set up. So we're kind of going to be flexible so that we can sort of best serve those funds based on their own goals and objectives and partner with them appropriately. So that's sort of how the MEDC fits in. And with that, I'm going to kick it over to Kristen so we can get into the details of opportunity funds and how they work.
Okay. All right. So we are going to hand it over to Kristen now. Let me just unmute her.
This is Kristen.
Hi, Kristen. We can hear you.
Great. Well, good morning, everybody. I've been asked to speak a little bit about opportunity funds and how they work from the perspective of investors. But to do that, I think we need to kind of go over the way the whole process works. I do understand that you have already learned about the opportunity zones that have been designated. At this point, they've been designated throughout the country by Treasury, so that's all done. So we're going to talk a little bit more about how the process will work as opportunity funds are getting going. This is an overview. This is a tax incentive that intends to take taxable gain that investors who own any kind of asset and sell it might experience and allow them to defer that taxable gain if they invest an equivalent amount in an opportunity zone. So it's a way of bringing private money into the distressed communities that have been identified as opportunity zones. The benefit to the investors, which you need to understand to sort of know about the power of the program, is that if they elect to invest in an opportunity zone and defer the gain from another transaction, they will be able to defer that gain and not have it taxed for about 8 years at this point. It's until December 31st, 2026, or earlier if they sell their interest in the opportunity fund. So that's the first benefit, a gain deferral, which since money has a time value to it, that's beneficial. In addition to the deferral of gain, though, if they hold the investment for at least 5 years, they will be able to have 10% of it forgiven, in effect. If they hold it for at least 7 years, another 5%, so that it's a total of 15% that is basically added to their basis, which is deemed to be zero, which means that when they either sell that interest or hit their day of reckoning in December of 2026, they have 15% of their gain forgiven and they pay taxes only on 85%. So that's the first two benefits. The next benefit is actually, in some cases, could be actually the bonanza that investors might be looking for. In other cases, it may not. But if they hold the interest for at least 10 years and then sell it, so it's a long-term hold, then they do not get taxed at all on any appreciation in the investment that has happened other than the deferred gain, which was taxed in December of 2026. So the additional appreciation in the property, if it's a property that they've invested in, would be tax-free. So you can see that that's going to depend a lot on the nature of the original investment and where it's located. So the incentives are likely to be different in different zones, but in a range. So that's what an investor can get. So it depends on investors being found who have taxable gain from an existing asset sale, which could be Amazon stock, it could be real property, it could be any kind of asset. And then they want to get the benefits of deferring an amount equal to that in order to defer gain and get some tax-free appreciation. So that's why it works. How does it work? The investor, I see that there are some questions here. Okay, I'm going to deal with the questions that I'm seeing now a little bit later. So the Qualified Opportunity Fund is the vehicle through which the investor must invest in order to get the benefits of the statute. So what is a Qualified Opportunity Fund? It has three basic requirements, so it's kind of simple in concept. It needs to be a domestic corporation or a partnership. It needs to have a purpose of investing in opportunity zones. And when it starts operations and as its operations continue, it needs to hold at least 90% of its assets in stock or partnership interests in qualified opportunity zone businesses or in qualified opportunity zone business property, which we will discuss later what that is. So there's an assets test. They need to have 90% of their assets in an investment in an opportunity zone, basically. So how do we know that a fund qualifies? There was an indication in the statute that regulations would be forthcoming providing for a certification process that Treasury would manage. There was some thought that it would be somewhat substantive. Treasury would review and respond to whether a fund qualified, although the tests, at least before operations, are actually pretty simple. But as it turned out, Treasury announced in April that they would use what's called a self-certification process, which means that a form will be provided that we haven't seen yet that a fund will need to attach to its tax return, where they self-certify that they meet the tests. We don't know what that's going to look like, as I said. It may be very simple, checking a box showing that they satisfy the corporate or partnership test and the purpose test. The ongoing assets test is going to be harder. We don't even know if it's going to be addressed in that form. But at least to start out, it's pretty simple and is not subject to Treasury review as it appears. There's no limit on the number of opportunity funds that can be created. This is not like, for example, the New Markets Tax Credit Program or the LIHTC program, where there is a scarce asset that is allocated, and so a variety of substantive requirements and limitations exist that limit the number of funds. No limit on this because it's not driven by a scarce asset that's being allocated. I see one simple question I'm just going to take now, domestic partnership or corporation. There's a little bit of a difference of opinion just because of the way the statute is written, but most people think that an LLC, which is taxed as a partnership or a corporation for tax purposes, would be able to qualify. That was one question because the words are partnership and corporation in the statute. But that's also pretty similar to some other statutes. They're talking, I think, about the tax characterization and not the state law organization, so an LLC could qualify. So let's look at the assets test quickly. 90% of the assets need to be held in the right kind of investment property in an opportunity zone. How is that tested? It's tested twice a year at the end of the first 6-month period of a tax year, and then again on the last day of the tax year of the opportunity fund. And then the average of those two results in terms of the percentage of assets held in an opportunity fund investment are qualifying. It's not 100% clear, as I said, whether there will be reporting about that or whether it's something that will just be looked at on audit. But that's basically the test that would have to qualify. So what happens if you don't meet the test? This is kind of interesting. It's not a situation like in some kinds of programs where there is recapture of the benefit, for example. It's merely for each month in a particular year, when the test is not met, there is a penalty based on the Internal Revenue Code underpayment rate, which is currently around 4%. So it's once you get back in compliance, the penalty stops. So it's in many ways not a draconian remedy compared to some other programs. And it does give you the opportunity to get back in compliance and just sort of pay for your temporary failure. There's also an exception if the failure to comply was due to reasonable cause, and there is absolutely no definition of what that means. We're hoping for guidance about what that might mean. And in particular, we're hoping for guidance that would allow there to be a startup period for an opportunity fund because it can be hard to ramp up if you're doing a multi-property fund and get all of your assets placed within a period that at most is 6 months if they literally go with the two testing dates. So we're hoping to get a longer period for a startup situation for a fund to invest. So that was the requirements to be a qualified opportunity fund. What can a qualified opportunity fund invest in? Well, it has to invest in qualified opportunity zone property. of which there are three types: qualified opportunity zone stock, qualified opportunity zone partnership interest, or qualified opportunity zone business properties. So as you can see, it needs to be an equity investment, really. There is no provision for a loan. It's either stock, partnership interest, or assets that can be invested in. So looking at this chart, you can see that there are basically three methods of investing, two of which are indirect. The indirect ones are investing in a partnership interest, which in turn is a partnership interest in an entity that is a qualified opportunity zone business, or investing in qualified opportunity zone stock, again, in a corporation that is a qualified opportunity zone business. The third way is direct, and this is interesting because it's not talked about that much, but the Qualified Opportunity Zone Fund could invest in a Qualified Opportunity Zone business property itself. So it could purchase property, develop a project, manage the project. Basically, the Qualified Opportunity Fund could be the developer and owner of the project. So that's a simple way to deal with opportunity funds that's not widely talked about. So what are the characteristics of a qualified opportunity zone stock or partnership interest? They have to be a stock or partnership interest in a domestic partnership or corporation. They need to be acquired from the corporation or partnership after December 31st, 2017, which is when the act went into effect, solely in exchange for cash. So you can't buy somebody else's partnership interest. You can't buy a general partnership interest. You need to have it issued by the entity itself. So it's kind of a new issue. It must be stock or partnership interest in a qualified opportunity zone business, which we'll talk about in a minute, or a business that's being organized for the purpose of being a qualified opportunity zone business. So it can be a startup situation. Then, during substantially all of the holding period of the qualified opportunity zone stock or partnership interest, the corporation or partnership must continue to qualify as a qualified opportunity zone business. We don't know what substantially all means. That needs to be defined in regulations. So what is a qualified opportunity zone business that you can acquire a partnership or stock interest in? First, it needs to be a trade or business, and substantially all of its tangible property must be qualified opportunity zone business property. Again, we don't know what substantially all means in this context, and we're expecting guidance on words like that haven't been defined, but we don't know what they're going to turn out to be yet. So those are the two starting points. In addition, at least 50% of the gross income from the business must be from the active conduct of a trade or business in an opportunity zone. A substantial portion of its intangible property must be used in the active conduct of its business in an opportunity zone. No more than 5% of the average unadjusted basis of its asset may consist of non-qualified financial property. This is a concept that if anyone in the audience has done new markets tax credit transactions, you understand. Basically what it turns out to be is reserves that are more than reasonable working capital, other kinds of sort of investment assets as opposed to active assets in the business. So there's a limitation on that because the idea is that the money is supposed to be actively used in the business. And then there's a prohibition on sin businesses, which are listed here: golf courses, massage parlors, stores that sell alcohol. You can see the list here. So what is qualified opportunity zone business property? So you'll realize that if the investment is directly in qualified opportunity zone business property, as we talked about with that chart, the direct investment, this is the immediate property owned by the opportunity fund. If it's an indirect investment through acquiring stock or a partnership interest in a business that is in an opportunity zone, then it's the tangible property owned by that business. So what is qualified opportunity zone property? It's property that's acquired by purchase from a non-related party. So this is kind of similar to what you run into in the LIHTC area with acquisition credit deals. The original use of the property in the qualified opportunity zone commences with qualified opportunity zone business, or the qualified opportunity zone business substantially improves the property, and during substantially all of the holding period, substantially all of the use of the property is in an opportunity zone. Another couple of uses of the word substantially all. So basically, original use would be, for example, you build a new building in an opportunity zone. You're the first user of that building. The substantial improvement, you buy an existing building that may be vacant or in need of substantial improvement, and you substantially improve that building. So those are the two ways that you can have tangible property qualify. So what does substantial improvement mean in this context? The substantial improvement test is property is treated as substantially improved if during a 30-month period after the acquisition of the property, additions to the property's basis, that's expenses to improve the building, exceed an amount equal to the adjusted basis of the property at the beginning of the period. So it's, in some cases it might be a high test depending on what the acquisition price is, because you have to spend at least the amount that you paid to acquire it. That would be the acquisition basis in a rehabilitation. This is much higher than the test that applies for low-income housing tax credit deals. It is about the same as the test that applies in the historic tax credit, but it can be a significant expenditure. So just to review what we've talked about, and then I'm going to go back and go through the questions. There are two ways to structure an opportunity zone investment. One way is the indirect way. So if you can look at this chart, you'll see that there is an opportunity fund that has secured funds from investors and has a managing member, similar to a new markets allocatee or a syndicator. That fund collects the money from investors who have gain they want to defer, and in turn, the fund makes an investment in a partnership or a corporation, which itself has a typical managing member from the developer side, and that lower tier partnership is the one that is developing the project. So that's the indirect structure. And I will point out that theoretically you can have opportunity funds that have multiple investors and multiple properties, but there are many complexities that have really not been resolved yet in guidance to doing it that way. So even though that's what a lot of people are thinking will happen, it's going to take a little bit of time before it can happen easily. It could also be, let's just go back to that, this exact same structure could be used for a one-off deal with a single property and a single corporate investor. That's much simpler and easier to do starting soon. Then the second way that the project can be structured is almost more like a bottoms-up approach, where the opportunity fund itself is the developer of the project. It's a partnership, say, that owns the project, and it brings in an investor limited partner directly. If it's done this way, the opportunity fund would still have to qualify, which should not really be that hard if it's a partnership, which is a typical way to do real estate deals, and if it has the proper purpose, which is investing in opportunity zones. It would have to meet the 90% of assets test, which if that's its sole asset is probably relatively easy. So that is the basic overview. Let me now go back and see if I can answer some of the questions that have been posted as we went through. So the first question is the 10-year hold subject to the 2026 deadline? And it is. That's a deadline that was basically part of the negotiations on the budget side. That was a way to make this work for budget purposes. So it's not a deadline that was made just because of the statute. But the result of it is that the result of that deadline, both on the 10-year hold and, well, actually, let me go back. Let me be clear about this. The 10-year hold benefit is not subject to the deadline. The deadline is the date that you have to recognize the gain. So you would have had to recognize the gain at 2026, but the ability to have your basis adjusted to fair market value and therefore not recognize the gain at the end of that 10-year period would not be impeded by that. It's just about when you have to recognize the gain. And the program does not end in 2026. That's when you have to recognize the gain that you deferred. But if you make an investment in 2025, then the program continues, we believe. The other thing is that people are hoping that the program will be extended if it's successful. There's a question about what kind of gain qualifies, and it's not, that's one of the things that guidance has been asked for. The statute does not use the word capital gain, it only uses the word gain. The title of the statute uses the word capital gain, but typically for statutory interpretation, the title doesn't govern, it's what the actual words of the statute say. So we're hoping for guidance about whether this really is as broad as it seems, and people are quite sure, obviously, that capital gain applies. People are not so sure that ordinary gain applies. Maybe some types of in-between kind of gain, like 1245 or 1250 gain, maybe. So we're waiting guidance on that. There is a question whether a medical marijuana facility is a qualified business. It's not listed in the sin businesses in the statute, probably because those provisions of the Internal Revenue Code were before there were medical marijuana facilities. I will say that most big corporate investors in similar kinds of programs have their own rules. These are banks, primarily insurance companies, and they mostly will not invest in medical marijuana facilities. So I think that's something that over time we'll find out more about, but now it's probably not going to be a popular investment. Well, there's kind of a related party question here that I think is, could an operating business sell a division at a gain and invest the proceeds in a fund and then have the fund invest back into a real estate deal in an opportunity zone that is partially owned by ABC Company? You would need to think through the related party rules that exist to find out whether you really could do that. It's not something that I can do without looking back at the statute. There's a question about how to access opportunity funds to build industrial buildings for lease and what is the benefit of those funds versus bank loans. Well, at this point, I don't know of any opportunity funds that have been formed sort of on a nationwide or regional basis. I don't know of any that have been formed yet because of the complexities of doing multi-property type funds. So you would be better off, in a case like that, looking locally for local corporations that might have taxable gain, that have some reason to be interested in investing because they are local in your facility. There are community foundations sometimes that have connections with high net worth investors that may be interested in investing in communities. So I think right now, the way to find investors is within the local community and not through some group of funds that exists nationwide, because that doesn't exist yet. What's the benefit of those funds versus a bank loan? The main benefit is that it's not a loan, it's an equity investment, so you're not going to pay interest on it. There are probably a variety of other things that one would have to compare, but that's kind of the main one that I think of. Of course, then you have a partner, and you have to deal with the fact that you have a partner. Is infrastructure qualified? The issue on that one is that the business needs to be a domestic corporation or a partnership. So if you're talking about infrastructure that is owned by a governmental entity, then that wouldn't work. You need to have a private owner, basically. Well, there's an interesting question. Will the property that is being rehabilitated in 30 months be considered qualified before the required level of improvement is met? I don't really think we know how that's going to be monitored yet. But that is something that arises in other kinds of programs that could be viewed as similar, like the historic tax credit. There are things that there is a risk that you will not actually achieve what's planned. But I think as long as you have a plan and it would qualify if you completed your plan, then a fund would probably go forward. Otherwise, you wouldn't be able to get financing at all for it. But I think rules probably will come out about that. Then there's a question, is the tax on capital gains delayed until 2026 and then applied to the remaining 85% that is subject to tax? And yes, that is how it works. There is no, to the extent of the amount you invest in an opportunity fund. So if you had gain of $100 and you invested $50 in an opportunity fund, then you'd pay taxes on $50 and you would be able to defer the other $50. So it's the amount that you invest. It doesn't have to be all at the gain. If I am a real estate developer of property in a zone, can I create a fund with the sole focus to develop my industrial park? Yes, I think you could. And you could actually invest your own money into that fund. If a business has, for example, accounts receivable, will it be disqualified due to these not being tangible property? No, as long as the intangible property is used in the business. Then there's a question, if you are a developer and are selling other properties and are considered a dealer, it is considered income and not gain. Is there a way to defer into an opportunity fund? That's one of the questions that we do not know the answer to yet, although it is doubtful. People generally do not think that this is intended to be a way to defer ordinary income. This is a good question. Do we expect this to be used in conjunction with other programs like brownfield efforts? And I would say yes. It's very much expected, although not necessarily intended, but it's expected that it will be used with a variety of other programs because in some ways, it's by itself, it might be considered a somewhat shallow incentive, but it's very interesting to see models of combining it with low-income housing tax credit projects, with new markets tax credit projects, for example, with other kinds of community development money. It really increases the return on those projects to the investor. So that means that it potentially could increase the equity into the projects. And just in general, I think that many other community development programs that are available in these zones, because the zones by their nature tend to have other programs, would be combined to bring in as much financing as possible to these kinds of projects. There's a question, do debt finance distributions result in a sale or exchange for purposes of the end of the deferral period? And that's one of the questions that we're trying to get guidance on, because there is nothing in the statute about that, and that's an important thing to know. So we don't really know the answer to that yet. There's a question, who typically sets up an opportunity fund? And as I said, sort of as we walked through the different ways to do this, there are a variety of basically market segments that we think might be doing this. Very obviously, there's a lot of interest in the field of syndicated low-income housing tax credit projects, where the investors in those projects may well be happy to have this added on to their investment because it will increase their return. So there's a whole market that already does that kind of project. Now, one thing about that kind of project is that those projects typically don't have a huge amount of appreciation at the end of the holding period. So the benefit that is about having tax-free appreciation is not going to be as big in projects like that as it could be in a more market rate project. So that's one group. There's also the group of folks who are already involved in low-income housing tax credit projects, for example, and other community development things, and who are now thinking of making a separate market segment that would do, for example, workforce housing that is not subsidized, but is obviously an area of need. So that would be a new product for those groups, and I know there's a lot of interest in trying to figure out how that could work. Then there are the real estate investment funds and the more private equity side of things, who are not that used to community development, but who have access to a lot of investors who would like to defer their gain and who would also like to get tax-free appreciation on a real estate investment. And so that's a whole different group that's not as familiar with the community development aspects and is probably going to be looking more at the opportunity zones that are the closest to being gentrified or near communities that are already gentrified and that have really a good potential for appreciation over a period of 10 years. So that's a completely different kind of group, but that group is also really interested. And then there's a question, how can small businesses best access opportunity zones for their capital needs? A new stock offering, question mark. Sure. I mean, the question is not so much how you do it, I think, as how you access the investors, which is a role that I think maybe somewhat played over the course of time with some of the other parties on this call trying to help facilitate bringing together investors and small businesses. And I think at this point, it's not as though there's a list of investors that you can talk to. It's just not yet to the point where you can really easily find those investors, other than, as I had said earlier, through your own community, I think. And then you can do it with stock if you're a corporation. So a new stock offering would be a perfectly fine way to do it. So can I just pause and ask whether I should continue answering questions? I feel a little bit like I can't hear anybody else, so I don't know if this is helpful or not.
Yeah, please keep going. I think this is super helpful, and we definitely have the time. So
okay.
Why don't we say go till 11, and then maybe we can find another way to follow up if people have additional questions or theirs didn't get answered.
Okay. Do my best.
Thank you.
There are a lot of questions, so I'll keep going. Okay, so there's what do you anticipate the local municipality's role being in writing policy or regulations to support opportunity zones? I don't really know how to respond to that except to say that in many states, local municipalities had a big role in choosing the opportunity zones. The selection of opportunity zones, the nomination by state governors of the zones in different states was handled very differently in different states, but in many of them, municipalities were pushing their own agendas with the state governors and succeeded in getting certain zones that they may already have intended to apply other resources to designated. In terms of now that the zones have been designated, I think it's probably going to be a local thing whether there is something for municipalities to do to enhance the fact that the zones have been identified. There's a question, after the 10-year investment in the fund is done, will any capital gains from a fund investment be taxable? So basically, the investment can last longer than 10 years. It doesn't really end in 10 years, but if the investment is sold after 10 years, then any capital gains over and above the deferred gain that you already recognized in 2026 would not be taxable. That's the exclusion from income of the gain on a sale after 10 years. And that sale could happen at 1 month after 10 years, or it could happen in year 15 if that made more sense from a market perspective. Then there is a question, are non-U.S. companies allowed to invest capital gains in a U.S. fund? If they're paying capital gains tax in the U.S., I think they would be, but I have not had that question asked before, and I don't think there's anything prohibiting it. Okay, then there's a question, any thoughts on the effect of an opportunity fund selling underlying property at a gain within the 10-year hold period, while the opportunity zone investors still hold its interest and the clock ticks towards basis step up? Well, that's a question that we're also trying to get guidance on. There is a provision in the statute that talks about forthcoming regulations to deal with basically the concept of a redeployment, it looks like, which is something that you have in the new markets area, so that if you sold opportunity zone property within the holding period, but within some reasonably short period of time reinvested it in another qualifying property, would that be okay and mean that the gain wouldn't have to be recognized and the project would still qualify, or the fund would still qualify? We don't know the answer to that yet. But what we do think, the question of whether, for example, if at the end of the 10-year period you wanted to sell the property, you wanted to buy out the investor, and to do that you had to sell the underlying property and then distribute the resulting proceeds, it would be nice if that distribution also was not taxable, but we don't know the answer to that yet. It's the sale of the opportunity fund interest. Gain on that is not taxable, but you can see that selling the property in order to be able to take out the investor is sort of the same concept. So we're hoping to get guidance on that, but we don't have it yet. And this is one of the things, by the way, that makes multiple property, multiple investor funds difficult, because you might have very different timing things going on, and you may hit the 5-year, the 7-year, and the 10-year period for some properties and some investors at different points than for others, and that's really complicated, and there are a lot of questions about how that would all work out. not to the adversity of anyone. Similarly, multiple investor funds are tricky because of the fact that an investor, in order to defer gain, must make that investment within 6 months after it recognizes the gain. And if you're trying to put in to a fund multiple investors that meet that trigger, and then also make sure that you have the qualified opportunity fund meet the 90% assets test for each of the investors, and they're coming in at different times, it's very, very complicated. Here's a question: does Holland & Knight serve as counsel to putting a fund together for an interested investor? And yes, Holland & Knight does. Holland & Knight could represent any of the parties, including a project developer or investor or a fund party, and we do that in other areas. We're very active in the tax credit area, representing syndicators and funds, so it's kind of similar. Although I will say that there's a different market that may appear for this incentive, because it may be that there are a lot of high net worth individual investors that will have gain to defer, and there may be a focus on putting together funds for individual investors. The market in other existing areas of community development is almost all corporations and banks. So that's a different market, and a thing to point out to everybody on the call is that there are real securities laws issues when you're offering an investment interest to individuals, and particularly on a multi-investor basis. There are exemptions available, but you need to be very careful to make sure that you're following the rules that would apply in terms of the securities law area, which is not such an issue in the low-income housing tax credit and new markets tax credit area, where you're dealing with corporations mostly and with a single investor typically. Here's another question about infrastructure. Would infrastructure required by a municipality for project approval be qualified? So, parsing that question, it makes me think that the question is, if a private developer is required to construct some infrastructure by a municipality, I think that would be qualified if the private developer was the owner and put the money into the infrastructure. That's probably going to be very fact dependent. Here's a question: are there any pratfalls anticipated in structuring a new markets deal with an opportunity zone investment? Well, there are, and I guess what I would say is that the easiest other program that it seems to fit together with opportunity zones is the low-income housing tax credit program. But the new markets tax credit program also fits together very well in a lot of ways, and then in a couple of other ways, not as well. So, for example, the qualified census tracts that were selected to be opportunity zones are the same basic census tracts that qualify for new markets tax credit purposes. So the location will qualify for both, always. The new markets tax credit, over the course of time, because it is a scarce resource that's allocated, has become more competitive, and as a result, it's been possible to impose additional requirements on new market census tracts, so that you have to invest in tracts that meet the basic requirements that opportunity zones do, but also have criteria of higher distress. So, although an opportunity zone will always qualify for the basic requirements of new markets deals, they may not be the most distressed and that qualify for the additional requirements that a new market CDE will need to have in order to make that investment. So that's something that may or may not fit. The other thing is that new markets tax credit investments are almost always done as loans, even though technically they can be done as equity. There are some tax reasons that that's by far not the preferred approach. In contrast, opportunity zone investments must be equity investments. They can't be loans. So you have to find a new market CDE who is willing to make equity investments, which is possible, and they would probably have to go back to the CDFI fund and amend their allocation agreement to permit them to make equity investments, because most CDEs don't say they're going to make equity investments, and they just need to get approval for that. The CDFI fund has indicated that they probably would be receptive to that, but there are just a couple of things that would have to be addressed in order to make it work. Can the money I invest in the fund in turn invest in my business or property? And the answer is yes. So if you think about the simple example where the fund is itself the entity that's developing the property, so you're the developer, you're undertaking a project, you have some money to invest, and in fact maybe your project requires some equity from the developer side in order to underwrite correctly. And if you had some gain from a prior sale, you could invest equity that is in an amount equal to that gain and get the benefit of the opportunity zone investment. And actually, right when the statute was enacted, I was involved in a new markets tax credit transaction where the developer was going to be putting in equity at a later stage. A pretty substantial amount was going to be required to make the deal work, and I know that developer was already trying to figure out whether he could take advantage of putting in money that he had recognized gain on. So that is something that can be done. Here's a question: can a community foundation create an opportunity fund to address housing? And the answer is I don't see why not. You'd have to have the fund be a partnership. The managing member could be the community foundation or a related subsidiary, and it could have a purpose to address housing. Next question is, if a business person is planning a separate LLC for real estate along with their operating business, could both be invested in by the same fund? I think probably, but I think we would need to think through issues about whether each of them counts as a trade or business. They probably would. I mean, you kind of have to go through all the criteria to make sure that both qualify. But I don't think that there is a rule that says an opportunity fund cannot invest in two aspects of the same operation. So I guess I would say that question is going to be fact dependent as you went through it, but I don't see something that initially says no. Can a state agency set up an opportunity fund, and if so, how would it best be utilized? I think a state agency could set up an opportunity fund as long as it qualified as a partnership for tax purposes. And a state agency itself couldn't be the fund, but it could be a managing member, for example, of the fund, or an affiliate could be. And how would it best be utilized? I think that's a question that's kind of beyond the scope of a quick answer. That's going to be very dependent on what the lay of the land is locally and what the state agency's goals are, I think. But I think it could. Can you give an example of how an opportunity zone investment could increase the return of a housing tax credit investor? Well, I can recommend to you most of the big accounting firms who have been producing models that assume a particular return. I mean, you obviously have to make some assumptions, but it definitely increases the return by quite a bit. I can't speak to it from my head because I'm not an accountant, so I don't carry numbers around in my head, but it's a substantial increase in return. And it's because the same money that is getting the benefit of the housing tax credit is also getting the benefit of the gain deferral. And interestingly, in a low-income housing tax credit deal, the 10-year hold is not, it's consistent with what you would be doing anyway. And there is some thought that not only would they get the time value of money benefit and the forgiveness of some of the deferred gain, which in and of itself increases the return, but they may be able to also not pay tax on the phantom income that comes at the end of a of a LIHTC deal because of the negative capital account, because that's gain. That's not 100% clear, but there's a lot of thought that that would work. So that's the why. I just can't give you the numbers of the difference. Can a municipality, a DDA, or a business improvement district either start a fund or be a party to a fund? I think that question is really impossible to ask without knowing how it would be structured and the nature of these entities. I would go back to saying it has to be able to be either a partnership or a corporation for tax purposes, which sounds simple but is not 100% simple when you're dealing with state agencies or, for example, tribal governments. There's a lot of interest in opportunity zones among tribes in various parts of the country. A tribal government can't be a taxable corporation. So they would need to create a partnership or use a joint venture. They would need to get some private aspects in order to be able to do an opportunity fund, which is not hard, but the point is that they just need to know that the tribe itself couldn't qualify most likely. Can a nonprofit corporation be a qualified partner in an opportunity fund or a qualified project? To start with the project, since you have to have an investment in either stock or a partnership interest, nonprofit corporations don't have stock or partnership interest, so they can't themselves be a project very easily, but they could form a partnership and be a partner of a partnership that issues stock, for example. They'd have to have another partner. And can they be a partner in an opportunity fund? I think the answer is yes, but there are a lot of rules about having partnerships with both nonprofit and for-profit partners that may impact the tax results for the for-profit partners, so you would just need to have those rules in mind and wend your way through them. Ideally, it would have a very small interest, and that would make it a little bit easier. So I think we're after 11 o'clock. I need some guidance about what to do now, whether to keep going or whether we need to wrap up.
Hi, Kristen. Yeah, you have a few more questions left, so it's up to you if you want to keep going. We can stop now. And I am taking all these questions on a document, and we can make sure any unanswered questions do get answered. So it's kind of up to you. You have a few left, but we can end it here if you'd like.
I can do a couple more.
Okay, sounds good.
Okay, the next one is residential rentals like apartment buildings a qualified property for opportunity zone properties? Yes, it appears so. Could an opportunity zone fund be a minority investment in a qualified property? Yes. There's no limitation on how big an interest the fund has in a particular investment. Are opportunity zone investors purchasing securities when they purchase interest in an opportunity fund? If so, is the fund making a securities offering? The basic answer, I think, is yes. And then the question is the offering exempt, which makes it easier to make sure that you're following the rules right. The most basic definition of a security is, are you offering to take people's money and invest them in something that will get them a return? And that's pretty much what an opportunity fund would be doing. But there are exemptions for certain classes of investors that can be taken advantage of. But it is something to think about. Actually, I think, now here's another question. Yeah, there are a bunch of mechanical questions, like can we get copies of the questions and answers? Here's another substantive question. Could an opportunity fund also be a new markets tax credit investment fund, i.e. one fund serves two purposes so that the new markets investor could use gain on its investment into a new markets deal located in an opportunity zone? So I think that's kind of a mixed question. One answer is yes, an opportunity fund could also be a new markets tax credit investment fund, subject to some of the things I mentioned before, that it would have to be a new markets fund that wants to do equity investments. I mean, basically you could be combining the two types of subsidies and invest in projects that qualify for both. And then the question, could the new markets investor use gain as its, use gain as its investment into a new markets deal located in an opportunity zone? And the answer to that is yes. There are models that have figured out what the implications of those are, and it does increase the return. You need to make sure that you have enough that's an equity investment, because new markets deals mostly at the upper tier have a combination of equity and debt. So you have to sort of figure out how much of it can be the gain, the deferred gain investment, because some of the upper tier money is debt. But it can be done. Let's just say that it can be done. If I am a real estate developer and I have zero or near basis in the new development deal, will all my gain be tax-free after 10 years? I have to say I don't really understand that question, so I'm going to have to skip it. Next one is, will a land syndication apply for opportunity zones? The problem with land is that there's a requirement for opportunity zone property to have the original use of the property commence with the taxpayer unless the substantial improvement test is met. So if you just are dealing with land only, there's authority in other areas that indicates that you can basically never be the original user of land because land has always been there. So you can't just do a land deal. And there are some various tricky things about buying land and putting a building on the land. Will the land qualify? And most likely, there's also authority that says only the portion of the land that's absolutely necessary to the building, for example, site improvements around the building, would qualify. But if you then have 40 acres that's an orchard, that's not going to qualify because of the original use issue. I think we're getting to the end of questions.
Yes, thank you.
Okay. Okay, go ahead.
What was that?
I'm just going to say somebody said I'm seeing anywhere from 9.8 cents to 26.3 cents. I'm guessing that was the increase in pricing on some type of investment. I can't tell when that comment was made, so I don't know what kind of combination investment they were talking about. But I think this is about it.
Awesome. Thank you so much, Kristen. That was really helpful. A lot of questions about how to access this. I will send this out in a direct email to everybody. So that will take me some time to get that uploaded to our website and YouTube, but I will do that today. So you can look out for that email later. And Bryan, I think you had a few closing words you wanted to say.
Just wanted to thank everyone. I know we, at the beginning, there were some individuals that we were at capacity and not able to make it. We apologize for that. Having said that, we will get the information out, the slides, the PowerPoint, the Q&A, et cetera. That will be forthcoming, so all of you have all of the information that was provided. The last thing I'll say is that I think we accomplished a lot here. There were 35 questions and 35 answers. And quite frankly, as I've said all along, answers provided by those that are at the forefront of this. So we wanted to provide that information. We understand that this is a different incentive tool. It's a, ideologically speaking, this is a great tool where investors are making the decisions. But as a result of that, there are many questions that still remain unanswered. So as we march forward, please know Gary Heidel on our team. Contact him. The email is provided. Contact him with any questions. If he doesn't have the answer, he'll talk to people that we deal with in D.C. to get you answers or put you in touch with those that have the answers. With that being said, thank you so much for your time, and we look forward to working with you as we march forward.
Thank you, everyone, and thanks to Mishta for making this possible. Hope you have a great rest of your day. And MEDC.